Silver's traded like energy now. So London, which can't get its silver back, is forced to go out and pay premium prices in the world. And now you've got US normal investors saying, I think I should buy some gold and silver. And you've got China normal investors saying, well, if you want to call them normal, they're not normal at all, they just buy all the time. I think I want to buy even more gold and silver and black. And then you've got looking going, oh shit, where am I going to get it? India's doing it too. What I'm saying to your audience is, I'm not just being wildly bullish. I'm saying that London's crisis, it is a crisis, but it's not the driver behind this market. The driver behind this market is China ETF buying, Indian ETF buying, US ETF buying, and the Trump-Xi war.
Hello, everyone. This is Jordan. Welcome back to the Daily Gold YouTube channel. Thank you so much for joining me. This video is being recorded on the afternoon of Wednesday, October 15th, 2025. And as I am speaking, in the spot market, we have gold right around $4,200 an ounce, silver $53 an ounce. And for our end of the month recap with Vince Lancy from GoldFix, Echo Bay Futures. He's also an adjunct professor at the University of Connecticut. And Vince, I'm really glad we waited a week or two to record this because a lot of things are happening in the market. Hey, what do you know? The metals, those $4,050 targets, they've steadily moved through those. So great time to talk about the market. I'd like to start with silver. Is there something else we should start with, or what's on the top of your mind right now?
I think silver's fresh in everyone's mind, and I think there are a lot of people asking about it, and I think it would help to give some clarity on what's going on and why it does, referring to London, why that does and does not matter moving forward. So you want to start with silver?
Yeah, absolutely. And I'll just mention silver. It has cleared $50 on a quarterly basis, daily basis, but not yet a weekly and a monthly. So we'll keep that in mind.
Okay. Wait, are you looking at futures or spot?
Spot.
It matters now. Okay. All right. Okay. So I have a couple notes here. I actually talked to someone else about this today. Right now, there's a short squeeze in silver, and the short squeeze is London specific. London does not have enough metal, if any at all. I'm being a little bit cynical. London does not have enough metal to make themselves comfortable handling any future or current future demand. And so because of that, they have started to seek to buy metal to restock their inventory, so to speak. And the problem with that is, in the past, when the global supply chains were more kumbaya-ish, they would use the COMEX as a warehouse. When they needed gold or silver, they just pull it from the US because we weren't doing anything with it. We don't make or sell anything. So they would just buy it. And then if there were demand in the US, it would get pulled back. So we'll kind of go back and forth, the gold and silver going back and forth, literally, sometimes transported literally, but usually the warrants would go back and forth. And that all changed after COVID on a global scale in terms of in terms of supply chains. But silver and gold were kind of neglected about that. So the relationship between London and the US is the most important relationship in the Western Hemisphere for gold spot and gold futures. So the US has futures. We have physical gold and silver, right? We're talking about silver here. We have the physical, plenty of it. But generally speaking, when you want physical silver, you call London. So it goes back and forth. It's kind of like a chain of command in the supply chain. And since the trade war started, right? Since the trade war with Xi, Trump, or US, China, you remember we had some months back in April during the Liberation Day of tariffs. During that whole time frame, the price of US silver spiked higher because we needed to pull it here. People were worried about the tariffs coming into effect and they wanted to get ahead of it. And that hasn't materialized yet. It still could, but it hasn't materialized yet. Now we're in a situation the other way where London is uncomfortably low on their supply. of silver. And I'm not even being sarcastic or cynical yet. That's coming. And because of that, they are looking to lease silver. So I have a couple of graphics. Should I put one of those up?
Yeah, absolutely. Go ahead.
Right. So here's a graphic of essentially it's a synthetic EFP. So the EFP is the exchange for physical. Those who are not familiar with it, I'm going to make it very simple for you. If you were to draw a line through the meat of it, right through the middle there, when the line is trading above the midpoint, it's US futures trading higher than spot. And that's normally the way the market is. If it's trading below the meat of it in the lower regions, that's London spot trading over futures. And there are a lot of things to talk about here, but just for simplicity and clarity, I think I could draw on this. Can I draw on this? Yeah, this is going to be helpful. This is the way the market normally is. It's in here, right? Now, what happened? You have these little aberrations, but we don't care about those, right? I can explain those. But see this here? See how it jumps up above the average and gets in this area here? This is when we were worried about Liberation Day. This is 2025 from January through April. This is where everyone was buying their silver because they were worried about tariffs. And then that was over, and of course it knee-jerked lower, and then it went back to the norm again. We had a little bit of another tariff thing here. And so, but it's all normal in an extreme way. This is normal in an extreme way. And then this happens. And there's nothing normal about that. That's London's price trading at a significant premium to the US. Now, that should almost never happen. And it almost never happens because there's plenty of metal out there. At least that's what they want you to believe. So why is it happening? Well, it's happening because the people who have the metal, meaning the US and China, are not making it available to sell to London or to even lease to London or to lend to London. And so what you have is you have a world that's gone from global stockpiles to regional stockpiles, mercantilism, what have you. And it's gotten worse. It's gotten worse because of the trade war. Okay, so Trump and China, US and China are doing this thing where we threaten more tariffs, and this is what's happened. We're going to threaten more tariffs, and they're going to threaten to withhold rare earths. So normally you're like, yeah, but what does silver have to do with rare earths? Normally nothing. But silver was just listed by Trump as a critical mineral. You've got this trend, this big picture trend of silver is now a critical mineral. The world is splitting in two. We've got to take care of our own resources. We can't expect to get it somewhere else. And within this time frame that's giving us our bull markets in precious metals, you've got this London goes, oh shit, where's my metal? I need to get some. And so that's what you have. And the US is not giving it to them, at least not in a pronounced fashion. And China is not giving it to them. So geographically, London is being squeezed by two nations. Now, on top of that, actually, let me pull up the lease rates. This is going to be interesting visually. All right. So when London needs metal and it can't get it, it'll borrow metal. So you can borrow metal and you can lease it. Hey, you have silver. I need silver to make delivery. How much would it cost for me to borrow your silver for 30 days? And it's usually like 1, maybe 2% a month. Nothing, right? Well, now, that's not it. We'll go to that in a second. Now it's this. Now this chart should be bigger. Unfortunately, I can't make it bigger. But the chart, maybe I can. Hold on. No, I can't. All right, so this chart represents the lease rate. Now, the dark blue line, how it's flatlining for most of the time frame on the left, that's a reflection of there's plenty of silver around. But at the very end there, if you could see the number, so this is
35%.
Yeah, you see that, right? You see that. Scary, right? So this is things normal. And this is things getting a little bit abnormal. And this is, to your point, 35%. So
It's a holy shit moment. Yeah.
That's a holy shit moment, right? Exactly. So last month, I'm London and you're the US, and I say, hey, Jordan, can I lease some metal from you? You say, "Yeah, sure, Vince. It's October of 24. You're like, yeah, give me half a percentage point for a month because it's Perra. Nobody cares about it. Well, now I go back and I say, hey, Jordan, can I borrow some metal? And you say, yeah, give me 35% of its value in interest per month.
Yeah.
Per month. So what I'm sorry, I'm getting texts from people that are important to me, so they have quacking. So 35% a month comes out to 400% a year plus. So I look at you and I say, wait a minute, 35% of the month, that sucks. And so I say, silver's not 35% higher yet, so I'll just buy the silver back. And so the spot price goes higher and higher because London is getting squeezed. And it comes back from time to time.
And that's the backwardation that we're seeing.
Yes. So exactly, that's the way to look at it. Back to this chart here, the lower part, when the lower part is over, the backwardation is, there's all kinds of backwardation, but the backwardation specifically is backwardation from London spot to New York. So you have your curve here. Here's New York futures, and here's spot down here. Now spot is up here, right? So the interest rate relationship is broken, just like it has been for gold. If this continues, the New York futures will go up like that, and that's starting to happen a little bit. And that's why you see the futures trading under the spot. And the representation of that is very simple. Hey, Jordan, can I have your metal? And you say no. And I go, well, you say, I'll give it to you in 30 days to just have to buy it. And I go, well, I need it today. Well, if you need it today, then you got to pay higher. So supply and demand comes to silver because even though they like to treat silver like it's financial, it's just silver. It's used, it's industrial. So if you need it, you need it. Silver's traded like energy now. So London, which can't get its silver back, is forced to go out and pay premium prices in the world. And the fact that it's so exaggerated or exacerbated, it's exacerbated by the Trump Xi coming conversation on October 30th, and the fact that they're fighting with each other about tariffs and rare earths. And it's exaggerated by in the US now, in the US, all the banks are raising their price targets of gold. And there's a new story out there now, one that we've never been a part of because we're metals people. It's the let's buy AI because it's going up. Let's buy nuclear because it's going up. Now it's like, let's buy gold and silver because of the debasement fear. You're even seeing it on CNBC. So all these stories that are out there they're either fluff to get you to buy metals because of the debasement trade, which is a real risk, or they're just trying to sensationalize to get clicks. But here we are, and now you've got US normal investors saying, I think I should buy some gold and silver. And you've got China normal investors saying, well, if you want to call them normal, they're not normal at all. They just buy all the time. I think I want to buy even more gold and silver and platinum, right? And then you've got London going, oh shit, where am I going to get it? India's doing it too. So this lower area, that's this down here, this is the backwardation that we're seeing from spot to futures. So yeah, that's it. I don't know what else. What else?
I think this is a good point in time for me to mention the technicals. And all this stuff is happening when silver is essentially breaking out from a 45-year base. And as I've said, this is in the history of capital markets, this is the second greatest breakout of all time. Silver breaking through $50 an ounce. A 45-year base, we've never seen anything like this other than 1972 when gold and commodity prices were breaking out of bases that go back to the Civil War. So it's at a point in time in the market where technically the supply around $50 is very, very limited.
Yeah. Right. There was no selling at $50. There was no one saying, except maybe for our uncles saying, I can't wait to sell my silver at 50. There's just buyers above 50. There's stops above 50 when you think about it. It's crazy.
The other thing I'll mention technically, Vince, is, as much as I'd like to see silver pull back here, the market never does what you want it to do. And I've been making this point in the last couple of subscriber updates, and I think I mentioned in a video or two. Silver up into coming into this week, it was not that extended technically. It was nowhere close to 2011, 1980, or even 2004 and 2006 when it made these intermediate term peaks. Silver was not as overbought as it was at those 2 points, at even intermediate term peaks.
Right. I pulled up RSI for you to give you an idea, right? I mean, where should I pull up a monthly for RSI? Maybe that'll help.
Yeah, a monthly. Yeah, you can look at that.
Look,
Yeah.
look down here, monthly RSI. Silver was all the way up here, all the way up here. Silver RSI is just getting to 2006 levels, 2007 levels, 2008 levels.
Or
So yeah,
can you pull up the quarterly RSI?
I think I can. Let me see. 3 months. Does that help?
Yeah, yeah, it does. Yeah, you can see on the look on the quarterly. The quarterly is not as extended as it was in well, it's about where it was in '06.
Right. So here it is. Here it is.
It's still below
it's
1973 or 74.
right. It's still low, it's still below 2011, and the market is above 2011. It's below 2000. It's above 2006. That's fine, but it's nowhere near where it was in 79. And so, to your point, people who say it's overbought, I love to see a pullback. It's not overbought, at least not by historical means. It has room to go. Pretty scary.
Yes, and it's important. And the great thing about your charts there is you're actually showing back to the 1960s because you see, I mean, I don't want to throw shade at Bar Chart and other people on Twitter because I've seen multiple people do this. Oh, silver and gold's the most overbought. Silver is super overbought, and their chart goes back to 1980. You are excluding the most important historical comparison for where we are now. Everything is pointing to 1972 or 1973.
Right, exactly. Yeah, that's because they're neo-Keynesians. They don't really have a sense of history. And true gold and silver bugs have a sense of history. A miserable, unhappy sense of history that's finally being let out of the bag. Yeah,
And look at the quarterly RSI. You can see there. I know the 1960s readings are a little, I don't know what the right word is. There wasn't really a market back then, but
not enough data to justify them. Yeah, yeah.
right. But yeah, you can see where we are. That's not the most overbought of all time. And the other thing I'll mention, Professor, is and I'm going to create a new analog chart showing silver's performance when it breaks to an all-time high. Now, in 1967, 68,
Right.
when it technically wasn't an all-time high because it did not surpass the Civil War peak, but it surpassed the 1920 peak. Now, if we throw in silver, what it did when it started moving in 1967, and then in 1971, 72, or excuse
There you
me,
go.
19,
There you go.
19, so we have 67 to 68, and then if you look at 73, and then of course 79, I'm pointing out there's basically 3 instances when silver broke out to a new all-time high. And
Right.
in every case, it basically just went straight up and doubled really quickly.
Yeah, like
So
this. Yeah.
based on that history, what Michael Oliver is talking about, based on history, that's damn possible. I've been saying it's going to hit 100 in 12 to 15 months after we break 50. But I mean, shit, the history is telling you it could be 6 months. It could be
Listen,
faster.
Jordan, you might be wrong. It might happen in 6 months. Right, exactly. You could be like wrong the other way. Exactly. How happy would we be? Yeah, I mean, look, I mean, I mean, just from a playing field point of view, I see a critical mineral that's involved in a global trade war, and the Chinese are buying silver beyond its industrial capacity needs. I see Russia buying it. I don't see it, but they said they were buying it as a sovereign asset. I see the Saudi Arabians buying SLV, which locks up the silver for their sovereign wealth fund. And I see the macro discretionary boys, the guys that we identified probably before anyone when gold cracked 2000, we identified them as playing. They're playing in silver now. And so we're in play. And oh, by the way, I do want to bring up something here. Hold on. This actually dovetails into, are you done with the technical part?
Yes.
I'm asking. This
Yes. Go
dovetails
ahead.
into what you just said. What you just said was, this is where we are, this could happen. And I talked about the silver, the London thing. But here's the thing. See, here's the thing. I want to show you that chart again. All right. Here's that chart again. The one we talked about, all right? So hear me out. This is like your indication that this is more like London is the story that everyone's talking about. But if everyone's looking at this saying, oh, Jordan's saying it's bullish, but the London thing could end if that heads, no, I want to show you why it's not true.
That's good, because I wanted to ask you a follow-up about that, but I think you're answering it now, so continue.
That's the follow-up. Yeah, exactly. No, look, these are questions that we ask ourselves all the time. So here we go. All right. Now, I want to try and make this as simple, as crystal clear as possible. When a market drops, I don't like that color. Can you see that? Can you see that blue?
Yeah, blue's a primary
Okay.
color, so that's easy for me.
All right. So when the EFP drops and spot goes over, that's bullish. When it comes back to this normal range that we see all the time, that's bearish or neutral. Now, when the market dropped, when this spread dropped all the way down to here, hold on, I want to change the color here. I'm going to go with red, all right? When the line dropped all the way down to here, that's bullish. No argument. That's bullish. But now watch. It's since gone from here back up, approaching neutral. And what has silver done for that time period? It's freaking rallied. Silver's supposed to be dropping when that happens. It's not. And what I'm saying to your audience is, I'm not just being wildly bullish. I'm saying that London's crisis is a crisis, but it's not the driver behind this market. The driver behind this market is China ETF buying, Indian ETF buying, US ETF buying, and the Trump-Xi war. This market will sell off if Trump and Xi shake hands and love each other and everything's fine. This market will sell off if China and London and the US stop buying. It will not sell off just because London is done. The demand for silver in London is driving that spread, but the demand for silver in the world is driving the price. And so, as this spread goes back to normal, you should see silver dropping. Meaning, I'll give you the breakdown. I think I have a setup that you can see. All right. So here's silver, right? Here's silver futures. See that there? It's trading $52 silver futures and 24 cents. Silver spot is trading $53.04. These two things I'm describing here are this spread. As they come back together and become normal, silver should drop, but it's not. This is not about London, even though London is the crisis that we're talking about. This is about the realization and the reawakening of a world to the need for a physical hedge against whether it be dollar debasement or China going off the dollar or India. You know, India has shut down. India has a lot of ETFs for demand. Give you an idea. They have their own version of SLP, and we wrote about it. And they've severed the ability to open an account to buy it. It's temporary. It does happen from time to time. But what every other country is doing that's not the US or London, well, London too, they're slowing buying down. No, we're not taking any orders today. You got to come back next week. And that's what's going on now. So I'm telling you that this thing, look, I don't want to be, a liar here. As this rallies, I'm waiting for silver to crap out. I'm waiting for that dip that you're looking to buy. It's not happening. And I'm wondering if this will not affect silver's price until after the rare earth thing is settled. So that's where I am. So technically, look at it from your point of view. I'm like, you should be trading short-term charts and, trading 1 hour and 2 hour charts. And you should be cognizant that as long as there is an uncertainty governing the market, then silver will remain bid. I'm sorry, one more thing. Today, this is like for your audience. Today, Scott Bessent came out and said, we're hoping for the rare earth problem to be put aside and to have a little bit of peace with Xi and Trump. Now, when he said that, U.S. rare earth stocks dropped 5%, right? Okay. So everything dropped on the equity side to that. Silver is still up. This is not like, this is about silver. They want the silver. I can't believe I'm saying that, but they want the silver. That's it. I mean, this is it. It's a real market.
Okay, Vince, for lack of a good transition, let's get into gold. One thing I want to mention before we get into gold, the last time we were on video together, you mentioned the macro discretionary. This is when gold was breaking out around 3,500. You mentioned the macro discretionary guys, and these are the big swinging dick hedge fund guys,
Right.
for lack of a cleaner explanation, somewhat masters of the universe. You were
Right.
very strong and said they're coming back in the market, they're buying again. And
Right.
looks like you were exactly right about that. Gold, clean breakout, $4,200 an ounce now. And again, it's not, when I look at history, it's a little extended, but it's not, I mean, it would have to go up another $1,000 to the point when we'd think, okay, this thing could correct 20 or 25% now. Like, it's not extremely extended yet historically. So I just wanted to give you kudos on that as we get into
Thank you.
gold.
Thank you. I appreciate that. Yes, because we have been all over this. You'll say this level is important, and I'll say macro discretionary is looking at it, and then the level breaks, and I go, hey, your level broke, and the macro discretionary bought. And that's what happened then. I personally got long gold for 6 weeks. Um, after that happened. And of course, on the way up, I'm slowly taking profits. And then for the last 2 weeks, I was long silver I thought silver would outperform, and at first it didn't. But to your point, I've seen this before. We've seen this before. When macro discretionary got involved, the big boys, the people don't understand, these are multi-billion-dollar hedge funds that don't have to follow any rules of their investors. They don't have to buy, be long, be short. They can do whatever they want. They have discretion, however they want. And generally speaking, as a force, they can take on a central bank. So picture a bunch of George Soroses back in the day. It's like that type of thing. And they're always careful not to overdo it, but that's what they do. So when they bought gold leading up to the election, there were a series of deadlines that made me realize that they were looking at events. So the election, they got long before the election. The election, it went their way. They stayed long, right? Then it's the tariffs. Then it's Liberation Day. They stayed long. Then they got out after Liberation Day, and we started traveling sideways between July and September. Well, actually, it was 4 months, but I'm only focused on two. And then they started getting back in above 3,500 when you and I were talking about this last, right in here. And it basically was as we broke out of this range, right? As we broke out of this range, they said, shit, I'll get back in. And they got in. And that's where we are now. So the question is, why, if they buy with a deadline in mind, what is their deadline? And I think these guys sniffed that the trade war is going poorly for us, and they bought in anticipation of a showdown. And maybe the showdown's coming. And to stay on the parallel, during that time frame when they bought in here, all down here when it ran up, when they bought and the market started to run up, who bought from them when they started taking profits? The bullion banks covered shorts. They got nervous, and the American retail started buying. And now I've identified the bullion banks covering shorts again in here, and the retail is now buying in here. So if you want to say that the market's overbought, it's not. If you want to say that it could run out of gas very soon, it could. I would be careful after October 30th, which is crazy because usually this time of year we don't buy it at all. Seasonally we don't buy it, but I think put it this way: I have some profits in those paper trades that I did, and I'm looking to buy physical. With the profits, that's how I kind of do it. And I'm kind of confused. I look at silver and I go, oh, I can double. I should buy silver. And I look at gold and I say, gold's not overbought. Like I don't know what to do. So I'm probably gonna do a little bit of. That's it. I mean, look, it's copper. The other day, copper rallied like. Let me pull up the copper chart. You want to freak out? Look at copper yesterday. Copper did this from 477 to 506 in one day. One day, that is. And now it's given back half of it. But this is the rare earth stuff. Like all the metals are in play, platinum, palladium. If it's something that we don't grow domestically, it's going up. That's what's going on. Anyway, enough about that.
So the masters of the universe, they could be taking profits now and selling to retail who are getting in because now we're seeing all these super bullish reports from the banks.
Yes, that's the whole conversation right
And it
there.
doesn't necessarily mean retail. They might lose money in the next few months, but 6, 12, 24 months from now,
Right.
they're not going to lose money.
No, to be fair to people that have a history of seeing gold, seeing the retail buy the top, when gold wasn't an interesting asset, retail bought the top. And now gold's an interesting asset, and the macro discretionary, who never bought before, they stayed away from silver and gold like the plague. And now they're in it. And so now they don't buy it because they're worried about it going down. They buy because they know that they're going to be able to sell it going up. They're that smart. And so, to your point, when gold made those highs in April and then traded sideways for 4 months, 5 years ago, it wouldn't have traded sideways for 4 months. It would have traded lower for 4 months. And so there's an increased liquidity. Call it the underpinning from central bank buying, call it the Chinese insurance companies, call it the Indian demand, call it the shortage of collateral in the West. And so I think there's a bid that's, I've been saying for the last 3 years, I've been saying that the floor in gold has been raised. So first I started seeing a lack of producer hedging, and then the central banks came in, and that's the floor being raised. They don't chase. But these bank reports, which of course I'm very skeptical of, these bank reports that you alluded to, they're raising the ceiling now. They're not saying, they're just like Jeffries, 6,300, JP Morgan. So everyone's got their own reason for it. 6,000 for gold if the Fed is compromised. Goldman Sachs, 5,000 for gold if the Fed's compromised. They're all giving you these stories. And you know what? These stories are, look, banks, research is a marketing tool for banks, but they're not always lying. Sometimes they really know sometimes they mean it, and gold is in play. And it could drop $1,000 tomorrow. But what like 30% above the 200-day moving average? It's like ridiculous.
Well, we have one note on that. You go back to the early 70s again. It was gold spent between tests of the 200-day moving average 3 years and 2 months. Right now, I believe we're 1 year and 11 months since the last test of the 200-day. So, gold could rise for another 7, 8, 9 months, and then maybe it has a sharp correction and test the 200 days. So I think at some point it will retest the 200-day, but based on that history, it could not even it could still stay way above it for another 6 or 9 months.
The 200-day could rise to meet it.
Yeah. I wanted to ask you one thing. Do you think the floor in the gold market now is at 3,400, 3,500 level?
Oh, yeah, I do. I do. And I say that because the macro discretionary bought it on the breakout. And I know that at least one sovereign fund and one central bank went up with them. So I think this is coming from someone on the China mainland who I trust. We talk about this stuff all the time, but I said, the question I ask every time we talk is, are they close to doing something? And he doesn't know, but we have a conversation about it. Are they close to doing something? And the answer is always no. It's still no. There's no reset coming. He goes, however, they're losing patience with their buys in gold, and they're starting to say, screw it, let's just buy more. Like, that's what he said. Now, he may not be right, but he certainly is plugged in, and he's been right about everything beforehand. So I believe that maybe the central banks in the world aren't chasing it, but I do know this. China's insurance company doesn't pick a spot and buy. They pick a spot and buy at multiple levels, because as they get new business, they raise their bid. They just keep going. It's kind of like, I have a buyer here, the market rise. Okay, I have a new buyer. They're not buying for themselves. They're buying for business. So I do believe that the floor is raised to possibly as high as 3,500, but certainly for that whole trading range we broke out of technically. there is one thing that I want to mention to you that's worth looking at. Michael Hartnett at Bank of America said he thinks that that he's looked at previous runs in the market, and I don't have the data in front of me, but it's something like the average bull market lasts 39 months, and the average bull market does X, Y, and Z, and based on that, the average gold if history repeats, and he's very careful to say it might not repeat, and this bull market by this metric he uses should could peak in the spring at 6,000. That's what he said. So I think that's a reasonable thing to look at. It's reasonable because everyone's looking at things like M1 and M2, and people are now openly talking about, well, my portfolio doesn't have any gold in it, and the funds are starting to put money into it. So it looks like a bubble, but it's not a bubble at all. Not yet. It's just raising awareness. It's a market that's been repressed for decades. Silver more so.
And I wonder if that 6,000, is that until gold corrects 20%? Like if gold corrected, if it shot to 6,000, then it corrected to say 25 or 27% after that.
Right.
I mean, does that mean it's a new, obviously, I mean, you don't know exactly what he's thinking, but
Right.
does that mean it's a new bull market after that? I mean, I just wonder how he defines a bear market.
I think he's a traditional technical person, like 10% is a bear. What is it? 10% is what?
20% usually is a bear.
Right. Right. So he didn't say I expect a bear market, but he would be saying, what is 10% called?
Correction.
Right. He would be saying, I like when we get there, he'd say, I'm looking for a correction now. And if we get the correction, he'd say, let's be careful of the bear market. And unless something changes that he sees statistically, then he would say, be out of your longs. But he's been long for a year now, and he's had his trading clients in it. So I think the other thing I think is looking at his work and your work, like what you just showed us with the whole, we're nowhere near overbought. Well, maybe we're near, but we're not at overbought. We could spend this. By what measure you're saying we could stay up for another 2 years, right? I mean, just I'm painting
Another year.
the broadest, another year. I'm painting the broad strokes. By what measure we can stay up another year, right? Or we can continue rallying for another year, or at least going sideways to higher. By another measure, RSI, we could be up for another 6 months. By price measure, we're nowhere near M2. That's something I'll look at, right? And by Hartnett's measure, we have another $1,000. Sorry, $2,000, and it should happen pretty quickly by the end of spring. So I kind of look at it like this: whatever happens first, I'm going to be less bullish, right? If the RSI jumps up to that level in the old days, I'll be like, all right, I'll be careful. If the market gets 6,000, I'll be careful. But unless that happens, the 200-day moving average is that's your final boss, right? The 200-day moving average, we have another year of this market. So maybe it's 8 months and 7,000. Who knows?
I would say we're definitely overbought now, but we're not so extended that we would correct 20%. At this level, 4,200 could go 3,500. What is that? About 15%. So I think you're not at a bear market risk using Hartnett's number. Like if gold peaked tomorrow, that's where it would correct, I don't know, 14 or 15%. I think that's the limit. Now, if gold kept moving higher, then clearly the risk of a 20 or 25% correction, that's rising, because that would put us on par with 72 and 73. Because in 72 and 73, we went a long time where we only had a 12% correction along the way, and then gold made a huge move up, which would be about, I think, 5,800 on the current scale. Then gold corrected 28% at that point.
Right, I remember that. I mean, not around. I remember seeing that in the chart. That was a big pullback. That was, what year was that? Like 74, 75?
I think 73. 73 was when you got the 28%. But gold recovered, and it still made a huge move after that up to the cyclical top at the end of 74, I believe.
Right, 73 and 74, gold was the best performing asset in the world, even though it had that retracement. And so 75, it sucked, and 76, it started up again. That's basically it. Yeah. I'm with you.
Okay, anything else we need to cover?
I do want to bring up one graphic. Can we go back to silver for a second? I have a graphic I want to show you.
Yeah, absolutely.
If anybody's wondering, this is a little bit of drama here, right? Let me find that picture. It would be here, and it would be, here's a picture that I put together. When people ask what the heck is going on in London, it helps to understand the market structure. So we know they don't have enough silver. They want more silver. They don't have enough silver. And we say, well, who is they? Well, London is all the bullion banks. Now, the bullion banks, there's like probably a dozen of them, but there are four that are absolutely, what's the word? Systemically important to the London market. And those are JP Morgan, HSBC, ICB, and UBS. HSBC and ICBC are essentially Canadian, not Canadian, Chinese banks. JP Morgan, we know, is American, and UBS is Swiss, European. Now, those four banks, they form something called the LPMCL. The LPMCL is the London Precious Metals Clearing Limited Corp. Now, what is that? That solid circle in the middle there is called an interbank clearing network. It's not an exchange. It's not a regulated body. It's a table that sits in between these four guys. Now, these four guys, at the periphery, they have their clients, bank clients. And when JP Morgan or any of these banks gets an order from a client, they turn to the client and they trade with him. They fill the order, right? But every so often, the bank needs to talk to another bank, like a bookie laying off bets. They will turn into that circle, metaphorically, and say, hey, guys, I need to buy something. It's basically, it's a competitive cooperative situation. And it's been around forever. And it's worked when we needed it to work. But now it no longer functions. And it no longer functions because there is no regulatory body that governs that. And it's basically trust. So it's four neighbors that are all bakers, and they all borrow sugar from each other when they're baking. And this guy, you've got HSBC. I don't know any HSBC, but HSBC keeps borrowing sugar from me, JP Morgan and UBS, and never has any to give back to me. So there's a problem here. We don't know who the problem is. I'm not saying it's HSBC. I'm saying that within that circle that's circled in red, that is not a physical market, Jordan. That's a derivatives market. That's a derivatives market where each bank faces the other bank and says, I'm good for it, I'll get you back. That's a futures contract. The London physical market, at the hub of the physical market, is a derivatives market. And I believe when this is over, and I have no idea who it is, I would be shocked if either one of these four or their clients were being less than frank about their portfolio. How's that? And it would come out the same way it came out with, was it nickel at the LME?
Yeah, I think so.
The nickel were on the LME. So a client said they had it, they didn't have it. It just, put JP Morgan on the hook, and a lot of things that should happen that should not have happened. But I'm describing something called an interbank clearing network, and these exist everywhere. The bond market has one, the bullion market has one, and the energy markets have one. I've experienced these as a user, and I've seen them work, and I've seen them blow up. And the fact that the metal is slowly moving to London, and they're still not talking to each other, means there's a lack of trust in the group. And that means someone's got something bad going on. And I don't know who it is. And I really don't know who it is. Probably a customer or someone. And we'll find out 3 years from now when it's over. But something is wrong. Something is not right. That's my opinion. I have no information, no evidence, but I've seen this before. If anyone's wondering what the precedent for this is, when the United States deregulated natural gas in the late 90s, early O's, natural gas was deregulated so it could trade at any price. But the electricity that was generated from it still was susceptible to state laws. So your electricity can't go up too much. It's capped. It's controlled. So all the energy firms that used to share sugar with each other to make a cake, they stopped sharing. And one of them was really smart, and that was Enron. And Enron ran the other ones in. And so at the peak of the stupidity of a natural gas crisis, the utilities that face that center circle there stopped talking to each other. And all that business went to the exchange because they didn't have credit. Your credit was no good with each other anymore. There is no exchange in London to handle this problem. So either they get the metal or this is going to blow up a lot worse. And I want to bring that up because this is the hub, figuratively and literally, of the problem. Unless I'm proven wrong. That's it.
What could be the timing of a blow up?
And I'm going to give credit to the people in charge, to the powerful people in charge on this. I don't think we'll know about a blow up until after it's over. Hear me out. We heard about nickel in real time because it was a small market, it was isolated. And you may hear about silver. But if you hear about silver, you're implying there's a problem with gold too. And you do not, it's like, let's pretend it's like what Deutsche Bank, I'll use a wrong example. Deutsche Bank had a huge derivatives portfolio that was just underwater, for like 10 years ago, after the great financial crisis. And everyone kept saying, these guys are where the problem is. These guys are where the problem is. And you found out that's where the problem was 2 years after they got out of the position. So I believe it's too important for the monetary system. Look, if that market seizes up, it's not nickel. If the London bullion market seizes up, it becomes a funding problem. These banks use their bullion to fund other businesses. So if the bullion market seizes up in London, the equity markets will seize up. It's the collateral that drives these markets indirectly and directly. So I don't think we'll find out. I hope we find out, but I don't think we will. So that's that's me saying I'm right even if I'm wrong. You can't tell. It's the negative proof. But I think that's part of the problem. I think London is disappearing as a relevant factor, and the war on earth is between the U.S. and China for natural resources, and London, for whatever reason, is not as important as it was. But they still have gold, so then we're still going to use it.
There you go. All right, Vince. Before we end this, please tell all our listeners how they can subscribe to GoldFix, which you guys, if you want to follow the market every day and know exactly what's happening, you got to subscribe to GoldFix.
Yeah, when you get the technicals from Jordan, then you come to us for the fundamentals or the stories or the explanations. It's GoldFix on Substack, so it's VBL Victor Boy Larry GoldFix.substack.com. We put out as many as 4 posts a day, so there will be potentially excessive emails if you're not used to that, but there's no trash in what we put out. If you sign up for free, you'll be able to see a video every day that'll allow you to prepare for the morning like a morning newspaper. If you sign up for premium, you'll get access to breakdowns of bank reports, insights into what's going on in the market, just as we discussed, and also some trading strategies without telling you what you should be doing. So we look forward to it. That's it.
Very good, Vince. Thanks for doing this as always, and be a little shorter wait until our next one at the end of October.
That's right. And you're going to New Orleans, right?
Yes, that'll be November 1st to the 4th.
Okay. All right. So we're going to have to maybe do it on October 30th or something like that. I don't want to mess with your travel plans. Nice jacket, by the way. You should start smoking if you're going to wear that jacket.
Yeah, it is a nice smoking jacket.
It's nice.
All right. Great work, buddy. And we'll talk again really soon.
You too. Catch you later.
Thank you for tuning into the Daily Gold podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.